Well, I want to thank you for joining us tonight actually. What we're going to do tonight, we're going to take a journey around the globe, looking for opportunities, the places that we should stay and the places that we should avoid. But before I begin, I have to have a disclosure, just for our protection. This is for educational purpose only, so there is no recommendation as far as specific investments. There are risks in investing in equities, in commodities, options, in bonds, especially international side of things. So this is just more of an informational. One thing I want to make sure we achieve tonight is, I'm sure you've been to many seminars, many presentations, you've gotten a lot of information. The problem is we live in an information age, so we are bombarded with lots of data. We can Google anything we want. So the difference tonight, what I'm hoping to achieve, is to get to the level of knowledge, actually the level of understanding. That's when we apply our knowledge. The problem is we are always stuck, again, in the information side. We know a lot, but the problem is we have a vast amount of information, like an ocean, but it's only 1 foot deep. We don't have the depth. We are bombarded with information, Facebook, everybody sends it, from Google to Instagram, we constantly receive. The problem is we do not know how to apply them because we don't have the confidence and we don't have the patience. So hopefully tonight, as I mentioned, we're going to have 2 segments. My goal is if we can learn and then apply it, and that will be success for me. So in the second part of the segments, we're going to go through all the 3 sites that I will suggest and do a little analysis, and hopefully you will be more of an independent thinker rather than being someone who will be listening to Bloomberg or CNBC of all the places and follow them rather than thinking for yourself. And hopefully, again mentioned, you will be a confident investor. All right. Why should we consider international investing? I started with this little story. As you know, Nikes are very expensive and very popular. And there's a lot of smuggling from China. Now, I don't know about this story, whether it's true or not, but recently there was some smugglers were caught. And the only reason they were caught, because on the shoes it said, "Made in America." So that tells you that this is the world that we're living. We are living in a global world. You look at your smartphones, you look at the cars, you look at the TVs. It takes, some of the smartphones, it takes 20 different nations to build that. So we are in an interdependence world, and because of that, we all have the exposure to international trades, international cultures, international economies. So basically, what had happened is people like Warren Buffett, he was very much domestic US oriented till a few years ago when he had to even go invest in a technology company in Israel, a car parts company in China. So he understood the value of investing internationally. The same thing with Investor Business Daily, which used to be my favorite paper. They competed with Wall Street Journal. The founder of that paper was Bill O'Neill, and he totally believed in US only. And we used to have this discussion, and he would say, once you're in the United States, you don't need anyone else. Well, a few years ago, you can see he's very much in international investing. If you read his paper, which is wonderful, they are very much discovering new opportunities around the world. One thing is, 2 of my heroes are Edward Deming. Dr. Deming was, you will hear a lot of soccer terminology. Dr. Deming to Japan was what Johan Cruyff was for Barcelona. He is the most respected non-Japanese person. He's the father of innovation and productivity in Japan. After the World War II, as you know, General MacArthur had to hire some people, and he hired Dr. Deming for rebuilding Japan. And Dr. Deming was working on the census side, and he started the management. And what happened, he emphasized the quality in productivity. And the rest is history. Look at Japan, what has happened. So he's very much respected, and that shows you about what happens when you apply the American management success overseas. The second person, which I have a deep gratitude, is John Templeton. He's a founder of Templeton Funds. Now it's Franklin Templeton. He's the father of global investing. And in 1950s, he's the one when he started the international investing. He wasn't not only a great investor, but he was a great person. And when he died at age, I think it was 94, it was a sad day for me, because he helped so many people through his foundations. And he was a magnificent investor. He started investing in the 1930s during the Depression. He borrowed money, about $10,000. He just bought hundreds of companies, and that was the time to get wealthy. So, all right. We're going to travel around. So, what is the first reason for investing overseas? Number one is growth. And when I speak about growth, I don't mean just a higher return, but also the growth in, as far as the middle income class, as far as the productivity overseas. So that's rule number one. That's why we look overseas. The second part is the diversification. You've heard the old adage, don't put all your eggs in one basket. This is one of the main reasons. I give you an example. When we've had a very volatile markets, let's say the markets are dropping tremendously, but there is a biotech company which comes out with a cure for cancer. Now, at that time, that company completely isolated from what is happening with the markets, because this is a new cure. It's a new solution for the disease that we've been wanting to find the solutions. So that's why diversification is important, because it looks at what is the correlation between the assets. So for instance, if in the 1990s and early 2000s, Japan was one of the low correlated economies around the world. So if I'm investing in the United States, I want to make sure something which negates if there's a downturn. So it's all about risk management. In the last few years, Turkey became the least correlated as far as world economies. So that's the reason the diversification factor is important. Well, how about risks? I think once we manage the risks, money will come. So we have to understand what are the risks associated with international investing. And I think that's one of the reasons that a lot of people have avoided investing internationally, because we don't understand them, or it's a lot easier, we call it familiarity or representative. So when you stay home, it's a lot easier to invest because you know your neighborhood. When you go outside, it's very difficult, but we cannot avoid it. So don't get scared. These are all the risks, and there are more. So let me start one by one, because once we cover them, and once you understand, I think it will be a lot easier for you to apply that knowledge when you're choosing your investments. Currency risk. The dollar, which is really the most used, and it is the go-to currency around the world, is the currency of choice for a lot of trades. But as far as investing overseas, what happens if the dollar gets strong? I give you an example. You're in UK. You have some assets over there, and the dollar gets strong. What that means is your British pound, for instance, is weaker. I want to travel to the United States. Now I have exposure to that currency risk. And currency, by the way, the Forex, is almost 10 times the equity market. It is the blood of the markets. And a lot of people, unfortunately, disregard that. And when you listen to, again, a lot of, it has gotten much better, but right around 2008, 2009, not many people will talk about the currencies. And I give you an example, like traveling in Europe. If you go to an 8-year-old in Turkey, he knows more about the exchange rate. He knows what the euro is. Earlier days, it was like franc, Swiss franc. You will talk about German mark. 8-year-old knew. And I used to test the MBAs in the United States, they didn't know. And the reason was because United States, which we used to, in 1980s, we used to be 1/3 of global economy. Now we are only a quarter. So we never needed to know about what's happening overseas. What are the currency risks? What are the exchange rates? We would travel, we just pay whatever it was. But it is now, we have to know. We have to know what the currencies around the world are and what is happening with British pound, which I will go over it with the Brexit, what's going to happen. The second thing is the political risk. The political risk, we just had an election in Brazil. We had election in Mexico. The Brazil was a far right, in October 28th, there was a far right government came in. In Mexico, there was a left of center government came in. So what is that affecting their policies? In India, we're going to have a big election coming up in 2019. How is that going to affect their attitude toward trade, which we will talk? What is going to affect them, for instance, what is the regulations, what they're going to choose as far as being a closed society or they want to be open society. The third thing is the transaction costs. So thank God for information technology now. And because of that, because of our access to information and because of access to the technology, the costs have gone much lower. I remember in the early 90s, number one, there wasn't really, couldn't use internet, you have to pick up the phone, and the fees were very high. And I remember because of, again, lack of the transparency on the things, you really had to rely on their broker, and you had to pay what they asked for. So it has gotten much lower, but still, that will be another reason you have to consider the risk. Regulatory, that's again, it's the government policies. What happens, we will talk a lot about China. In China, I remember Motorola decided to go in, right before McDonald's decided to go in. They spent hundreds of millions, and then the Chinese government, after they accepted that, admit them, they just said, well, we decided not to. So these are the risks. Yes, for spending hundreds of millions, they decided, well, this is not the time to accept you. So I'm going to emphasize the cultural risk because that's something that is it's more of a qualitative rather than quantitative. What I mean by that is we look at the GDP of the governments and the economies, but we forget about the cultural side. One of the things are the corruption and the bribing. A lot of you, if you go to emerging economies, we look at bribing. In the United States, bribing on a smaller scale is not accepted. Of course, if you're in New Jersey or Chicago, you do it big scale. We're taping this, but anyway, but in countries like, you know, in emerging countries from Egypt to India to Turkey, it is part of their culture. And they call it, you can call it bakshesh, or you have to. So if you know the skills, all of a sudden, someone can have a successful business and someone could be out in the streets. I use an example. I had a friend who purchased a property with his buddy. They bought 2 apartment buildings in Armenia. Exact same thing. They spent the same money, except he went to the authorities. They said, well, you know what? I bought this property. Here's a $5,000 just in case. You just watch it over. A year later, Armenia had a great growth spurt. About a year and a half, 2 years later, I think the property was up 70, 80%. So this is a great money. So he goes and he decides to sell it. Wouldn't you know it, that his property was sold at no time. His friend's property is still on the market. The property is not to any amount that you can think of, just because he knew the system. So it's the system that you have to know, and the culture of these people that we have to know. If you are going to invest, you have to deal with their exceptions and their exceptions. Another example is like in Eastern Europe. I use an example like in Romania. If you're a speaker and you're invited to a company, the CEO introduces you, and what happens, if you start speaking about what you're supposed to speak, they get offended. Because what they want to know is you're there to just accept the introduction and then say how the CEO is so wonderful and start talking about the CEO and let him take the podium. On the other hand, if you go to South Korea, they get offended if they introduce you and you didn't give them the knowledge of what you knew. So these things play a big role when you're investing in different countries. Interest rates. Obviously, there's been a lot of talk about interest rates, which we will talk about. Interest rates play a big role because the fixed income market is a lot bigger than equities. So what happens, if you know the country's interest rates and what is the outlook, you can have a better understanding of what's going to happen to their equities. I remember in 1980s, again in Turkey, interest rates were 70, 80%. People would take money, I know, like from Iran. They will take it over there, and except the problem was, with the higher interest rates comes inflation, because your money is cheap. You can just print that money. So the Turkish people will call it zam, which is the inflation. So what vision we have of those inflation, and the same thing with hyperinflation in like Brazil and Argentina, if you remember in the 1980s, it was so bad that in Brazil, people will not take a taxi ride, they will take a bus, because you give the ticket in the beginning of the ride, because if you took the taxi ride, by end of the ride, you had to pay double the amount because of the inflation. And in Turkey, the same thing. The inflation was so bad that the currency got so affected that I think it was in 1990s when Süleyman Demirel was the president, he promised his population, he said, I'm going to make you all millionaires. Well, lo and behold, what happened was the dollar exchange went from $1 to 47 Turkish lira in 1980s to $1 to 1.1 million, and I think the last was about 2001 when it was 1.4 million. So everybody was joking that he was right. Everybody became millionaire, because if you want to go on a taxi or something, you have to pay 5-6 million. You got to buy suitcases to go on a ride. So that's how the interest rates affect with the inflation on top of that. Geopolitical, that's one thing again we are hearing a lot about nowadays, and it affects you. So the geopolitical you can hear, obviously, Iran, North Korea. Now, we got problems in the Middle East. Today, as you know, Saudi Arabia, well, there was a vote that they are not honored with the Saudi Arabia because of Khashoggi. They're not going to sell more weapons, and they're going to pull out of Yemen. So geopoliticals do affect the investments. The only thing I have to tell you about politics and geopolitics, over the 100 years, they are more of a noise, because it's the earnings and other economical factors who make you the money. But in the short term, and with the environment that we are in, from Macron in France to, again, UK's Brexit and May, and of course the United States with Donald Trump, we have all these geopolitical challenges, what it brings uncertainty, and when there's uncertainty, that brings volatility. Information. Now, what I mean by that is, again, there are still governments out there that they do not allow you the free press. So you don't know what information you're getting. We will talk about China. Again, with all the access to internet and other things, you still, which is much better now, you still do not have access to the full transparency and full information. So that's another risk. Liquidity, again, especially the smaller the economy, the harder it is to, you can take the money in, but you cannot take it out. So that's the problem, which will, for many reasons, because of that, it's not liquid. And that's one of the, again, in the United States, one of the reasons we are here, because there's just so much available and there's the liquidity. But some countries do not allow you to have that liquidity. The legal side is more of, again, how difficult it is to start a business. Like in Brazil, it will take 80 days to start a business versus United States, which takes 6 days. In UK, it takes 5 days. In Venezuela, I don't know who would want to start a business, but it takes about 380 days. So these legal things, and also, do they have regulatory bodies, like we have SECs or FINRAs here, and how much they have the effect in those countries. And the last but not least is the trade wars, that you hear a lot again about these things. And the reason it is important now is just because of, again, China. And I will go over it, but it is, in the short run, makes a difference. In the long run, it has never been successful. When you don't have an open society, it makes it very difficult, especially with the global environment that we are in, to be able to trade freely. And trading freely is the key for success economically. So where do we invest? And what opportunities we have? So basically, when we look at the markets, there's 3 types of markets. There are developed markets, which is most of Western Europe, United States, Japan, more established markets. Then we have emerging markets, and then we have frontier markets. Developed markets are countries that they have highly developed capital markets. They do have regulatory in place. They have, obviously, the liquidity, and they have high levels of income and per GDP. Now, the question is, that's like the GDP, I mean, China is very large, but still considered, believe it or not, an emerging economy rather than developed. And the reason is because of the controls that they have, and we don't know what we get in because of the transparency. And they're still growing. What I've put down here, and by the way, you will have a copy of this presentation. I will email it to you, so you will have access. So I put down all the international stock market returns, and I mentioned in the beginning the growth, why you should invest internationally, because you can see that some of the, like in 2004, Austria was up 72%, and it comes all the way, and then the first half of this year. So these are the markets. US sometimes in the middle, sometimes, but it's hardly, because we're very established and large economy and markets. Usually we are not like a number 1, but we're never like a bottom either. So I will let you review that, and I just wanted to have you access to the information. Now, emerging markets, on the other hand, are the developing markets, the markets that I will call like the small cap of stock market. So what will happen is with emerging markets, there's the same, they don't have complete characteristics of developed markets, but they have a much bigger potential of growth. one of the things is about the young population. Demographically, a lot of people are in the middle class is just up and coming. And I want you to go back to turn of the century, the 20th century, and think of the United States, and think of the Industrial Revolution, and think of what has happened over these years. Think of telephone, think of, we come back, the airplanes. So that has made the world a lot smaller. And then we have the internet revolution. Now think back and see what happens, what we were in 1950s, and you watch, Father Knows Best, or if you watch any of those. These are the times that it was right after World War II. We had come back, and the economy was just growing, and we had the father. It was usually the single income, but yet they had a very comfortable life. Everybody owned a house, most of the people, and that's, just go back and think of these emerging markets, what they are going to be in next few years when they are moving from the manufacturing and industrial production to more of a service-oriented. The consumption by 2025 is going to be about $35 trillion, $35 trillion in these emerging economies. What that tells you, we are consumer-oriented. What will happen in these countries? They're going to buy stuff. I remember in 1990s, the revolution didn't happen. Asia didn't grow because there was this magic technology or magic management tool. It grew. I remember in Malaysia and Indonesia, it grew because of satellite dishes. You are a young person in your teenager or early 20s and watching the movies through their satellite dish, and you see these Americans, the children, they own, well, first of all, families own 2 cars, they have a nice house, they even own 2 TVs, and they said, why not us? So the drive of evolution in Asian markets and a lot of other emerging markets was the access to see the drive within. So it wasn't anything, there wasn't the revolution, there wasn't like a US government went there and said, well, you got to change your economy. It was the drive within, which that's what makes it exciting about the future of emerging markets. So here, I have, again, you will have access to this. So it shows what has emerging markets as a whole. This is the MSCI emerging markets, which is a Morgan Stanley Capital international as far as the index. And they've looked at what are the returns, and you can see like in 2017, emerging markets as a whole did 37%. This year, beginning of the year, everybody loved emerging markets. Right now, everybody hates it. So what do you do? When everybody hates something, that's when the good time. So it's the sentiment we call. And again, I have put down the next slide. In 2004, Colombia was up 133%. They're leading again. China was 82% in 2006. So basically, the potential for growth is much larger in these developing countries. And again, you will have access to this information. The third part is something called frontier markets. Now, these are the babies of the emerging markets. They are the ones who are going to develop, but they don't have developed markets yet. So some of the countries, a lot of African nations, there's like Vietnam, which I will talk a lot about Vietnam, some Eastern Europeans. We have Argentina, used to be frontier, then it became emerging, now it's become frontier again, which again, on the side, you will see the countries that they're considered frontier. I will call these micro-cap. They're countries that they are ready for initial public offerings, right? So they are like really new company, but they are successful, but they don't have the markets capitalization to be included in big boys club yet. But they are very exciting. They have a very hard-working youth demographically. They are energetic, educated, but they just don't have the opportunities yet to show. So one of the exciting things about these markets are, as I mentioned, demographic. Basically, what happens is we have the median age in these countries is much lower. So believe it or not, the median age in actually Niger is 14.9 to 15. The median is what is the halfway between the highest and lowest. What that means is, and I will talk about a lot about Africa, about opportunities in Africa, is they have a very young population. The problem is, obviously, they don't live, their life expectancy is not as high as other countries. So, for instance, in Niger, the 51 is the life expectancy compared to Japan, and like Monaco, which are like in Japan is over 48, and Monaco is even 51. That's the median age, because people live a lot longer, and because of that, the median age is much lower, they're healthier, the fertility rate is much lower in those countries. But I am very positive, I think in the next 20 years, because of the health improvement, hopefully because of the lower corruptions, but also the cultural changes in these countries, we will have a higher potential, and hopefully the median age will be the driving force for their growth. And again, we will talk about that. But what challenges bring with us in like European countries such as Spain, and you see Germany and Italy and Austria, with all these aging population, who's going to support them? What is happening? We are living longer life, but we don't have, like again, the fertility rate in Europe is 1.62. Actually, we went down as low as like a 1.4. So who's going to support? If I'm going to live to be 90, and if I have these social programs, I need a driving force. And that's what makes it exciting about these frontier markets, because they have youthful, hungry, educated, informative. Because of the technology, they have access to everything that they need, and that's going to be the driving force for the next 30 years. So we don't see Germany, even Japan, to be the leaders. It's going to be unknown countries. Again, countries such as Iran, they have a very youthful population who drive for education, and they have very rich natural resources, and a lot of these countries have in common because of their natural resources. And because of that, or Vietnam, for instance, these kids are hungry. They work very hard, they don't get paid much, but they want to succeed. And success is the key for the future as far as the growth goes. All right, I want to talk a little about this Walter Wrinston's law of capital, and I will read it with you. He was a banker, a famous banker who died a while back, and this is what he said. He says, capital will always go where it is welcome and stay where it's well treated. Capital is not just money, it's also talent and ideas. They too will go where they are welcome and stay where they are well treated. So it's not just about money, it's about here. Let's talk about, believe it or not, in 14th, 15th century Spain, that was a thriving economy. A lot of capital was actually going there. Very, very flourishing country when it was Spain. Till 1478 happened, an Inquisition. What happened? They closed. They started persecuting people. Guess what happened to those people? They went to Holland. Holland accepted them with open arms. No biases. They said, come on in. And all these great minds and capital flew to Holland. And the next is history. You look at the capital markets. You look at the trades, 16th, 17th century, 18th century. That was Holland. And that's why a lot of Dutch people are very good marketing people. They speak 4 or 5 languages because of the shipping. They've traveled a lot, and they are very good in management and again in marketing because they had that exposure. And let's come forward and look at the Nazi Germany, 1930s. What happened? A lot of them came to the United States. A lot of scientists, physicists, the Manhattan Project came to the United States because the United States opened its arms and said, come on in. And not many of them wanted to leave. They stayed. And that's what we foresee for the future. I look at, again, the countries that are open. And that's one thing about immigration. And that's what, if we have a closed immigration and not allowing the minds to come here, that's going to stop our growth. And that takes me to China. We talk about China. China is the second largest economy in the world. And there's a lot of talk that they're going to take over the United States soon. When we say soon, like by 2050 probably, they thought, or 2045. But as long as they have this attitude that there's no transparency, and as far as they're not allowing people to live with their will, they're not going to have this. None out of 90% of PhDs, Chinese PhDs who come to the United States and Europe, they stay. They don't go back. Any money that Chinese people can take out, they take it out of the country. The same thing with Russia. They will take the capital out. So as long as you have this, you're not going to have the growth. And that's why I emphasize the capital is not just with the financial side, but also we're talking about the human side. All right. And that brings me to Heritage Foundation does that every year they do economic freedom. And they look at how free you are as far as financially, as far as being watched or having the freedom to do financial transactions, to move the money in and out, to have freedom from doing businesses, how easy it is to businesses. And for many years it's been Hong Kong, Singapore, and now it's like New Zealand and Switzerland. So this gives us an indication what is the future for the next 10, 20 years, what we want to look for. I put this in just to tell you, I will have some charts if you don't mind. I just want to share it with you so you have access to these anyway. This is called, again, this is the Baltic Dry Index. And what Baltic Dry Index does, it shows what is dry goods. This is the shipping rates, but the dry goods around the world charge. This index, it has no volume, it's just the price. So when you see there's a growth, when things go up, that means there's activities. When things go down, that means they're charging less because there's no activities. So where we are right in the middle right now. So that tells us that the world economy is still good. We don't have, people ask me whether we're going to have recession, we're going to have crash. I don't see that, but I see the slowdown. So the world GDP for next year and the following year, we're going to have the slowdown. And that's where we have to look for where is it going to be the acceleration and where we should put the money in. But this gives us a little like a non-biased, because people talk with money, with their own money. And this is the shipping companies talking, telling you how much traffic they're having and how much they're charging. All right. So let's travel. And now I mentioned dollar. Dollar is very important because that is the blood of economy. The world works with money in dollar. So what happens to dollar affects what happens to the economies. Now, a lot of emerging countries have borrowed money, and guess what its denomination is it? It's in dollar. So when next year they have to pay it back. Now, if the dollar is strong, is it to their benefit or is it to their disadvantage? Because they have to pay it in dollar. So because of that, they have to give expensive money back, that affects their economy. So what the dollar does, when the currency is strong, it's good, because that tells you this economy is good. But when it's too strong, on the other hand, that means nobody would buy your goods because you're expensive. And that's one of the reasons we will see, like Europe, because there's been a slowdown, because they're export oriented, they're happy with weaker currencies. I mentioned the chart. So this is a chart of dollar goes back to 1995. As you can see, we are right in the middle. Our forecast is that dollar is probably topping, which is not very good news for stock market. Usually you want to have the stronger dollar, but it is good news for international investments, for emerging markets. So we will talk about Euro, Brexit, stronger dollar, it helps their exporting business, but it hurts for the emerging countries when they have to, again, pay their debts. Now, with Brexit, we will discuss what's going to happen in the UK shortly. So one of the ways to find out if a currency is expensive compared to dollar or compared to each other, there's something, economists came with a Big Mac index. What that means is they wanted to know how much of a Big Mac will cost around the world. So based on that, because McDonald's all over the world, and it is a company that is, don't like the food or whatever you want to say about it, but it's accessible. You go overseas, every country, the kids, what do they want? They want their Big Mac. So this is as of July 18th. As you can see, Switzerland's, it takes $6.57 to buy a Big Mac. In euro, it's $4.75, but compared that to Egypt, it takes $1.75. So that tells you, again, Ukraine is $1.91. Well, there's a reason they're inexpensive, because there's a lot of risks too, but also the cost of living. But if you want to look at the currencies, this is one of the ways to gauge that. The second thing I use for finding out what is, as far as currencies, is something called KFC index. So you're going to be a food expert before you become international. So why do you use KFC index? Because in Africa, there's only 3 countries which they have Big Mac, but 22 countries have Kentucky Fried Chicken. So this is specifically for African countries, and this is a little old numbers, but just give you, so we use like Angola and Morocco, it's overvalued, and in Egypt, again, Egypt has an undervalued currency. Just a tidbit for you. Interest rates. There's a lot of talk, a lot of people are worried why the economy is slowing. What is going to happen to my mortgage rates? What's going to happen to credit card rates? What's going to happen to my interest, my personal loans? And so, as you know, the central banks, the Fed, decided to tighten. We've had 6 tightening. We had all the easing. The interest rates were going down. We went to 0 almost. And now we've been going back up. So what that means, it's a little harder to borrow money, or it's more expensive, but we're still in a sweet spot. So what happens with the mortgage rates? Mortgage rates follow the 10-year notes. 10-year notes is a 10-year borrowing cost on the treasury notes. It's usually 2 weeks after. So people who want to finance, they have to follow the 10-year notes. So what I've done, again, I will give you these charts, so forgive me, but it makes it, I love pictures. I've gone back to 1981, and as you can see, there's that red line that you see, that's something called trend line, and in charts we use. Every time we've hit that line, we've come down, and now we just broke it. That means from a long-term point of view, we are in a increasing interest rates. But in the short term, we can see we hit a sweet spot and we are going down. So my question is how long this will take, and is the Fed, which is next week, that December 19th, they're going to come out with, they're going to increase the rates again, but will they stop it? Will we have 1, 2? They will talk of 3 rate increases next year. Based on this, I think, and based on the, we call it spread between 10-year and 2 years, the things are going, they call it inverted yield curve, so I don't want to get too technical, but that means that if you borrow a 10-year, it's not much different than if you borrow the 2-year. So that means that people are paying more for the 2-year rather than 10-year. So that means there's a fear that the economy will be slowing down. So what is going to happen with that? I don't believe there's a recession in the picture, but we are in a slowing economy. So people who wanted to borrow money, they were worried about mortgages, I think they will be happy to see that the rates are actually lower, because we did go up, and that's one of the causes of the real estate, and we'll go more in details, that there was a fear of, okay, increasing rates is not really good for the real estate borrowing and refinancing. One thing about this 1981 was the peak of, that's the highest we've been in interest rate. Well, most of you young, but I remember borrowing money and how expensive it was. People were buying houses, the mortgage rates were 15.5%, and they were paying for it. They don't realize that also the most consuming is in our 25 to 45 years of age. When we are between 25 and 45, that's when we are working hard, that's when we buy things, that's when we consume things. And the baby boomers were coming in that time. So they were borrowing money because they want to have a place to live, and it continued. So that's one of the reasons the interest rates actually kept going down, because there was more demand for the bonds and borrowing. Now these baby boomers are actually retiring. So there's that pressure that they're actually doing the saving side of things and more of a distribution rather than buying. The question is the new millennials are going to take and start borrowing money for the houses? And we don't know. I don't see that yet, but hoping that they be active at least in purchasing their first house, or the wages are growing, but that's a concern for next year, whether the economy is going to continue this growth path they've had. Is the growth path because of all the easy money, or is it the fundamental reasons? I mean, we have let's face it, we have the lowest employment rate, but how much is it real? Most of it is, but there are some people who were disgruntled, they're not working, they retired sooner than they should. So hopefully that the growth will continue, but we feel that it's going to be slowing down. All right, gold. We talked about diversification. Gold is, we call it the store of value. So the gold is not mainly for investing. Gold is for more of insurance and protection. So people use gold in a sense that you go back 5,000 to 6,000 years ago, nothing has changed. The gold has that value as far as because it is something that you still can produce, but not as much as you could. So they usually use that gold for the store of value. So it's not really, we don't look at it as an investment, but it is a good part of your portfolio. It should be just in case of crisis, in case of something with inflation, for instance. If the companies are printing money, what will happen, we call it fiat money. If my money is not buying as much, what could I do? I could use gold or gold coins. Now, we are, again, in the short term, I think the gold is overheated. We have it's about $12.50, but we are positive about gold future. And also, I think the gold miners, because there's a lot of them actually could not produce as much, they closed, a lot of politics were involved. So I think in the long run, gold miners might be a place you should you should explore as far as opportunities. I'm going back for the past 70 years. Let's compare it to 2 months ago. You're buying the gas and you see the oil goes to $75. There's a talks of Iranian sanctions. Oh, what's going to happen? They cannot sell it. And then since then, what has happened? The oil actually went down below $50. Now, in some ways, we have to look at crude oil in 2 ways. Number one, from the consumption point of view, a lot of consuming economies, such as India, China, a lot of like Turkey, Taiwan, now they're using Western Europe. Then we have to look at the producers. Now, how their economy gets affected. We got Russia, Saudi Arabia, look at Venezuela. So obviously, low oil prices affects those producers because they don't have as much, obviously, revenues. But it's good for the the countries that they use them. One of the reasons crude oil prices came down, obviously, the fear of Iranian sanctions when they allowed them to be able to sell to the 7 countries 75% of their production, so that didn't really pan out. Then Saudi Arabia comes out talking about politics when the journalist Khashoggi, well, he was murdered in Istanbul. What happens? Saudi Arabia pumps the oil, brings the prices down, and then OPEC meets last week, and then Russia, and they decide, oh no, it's too much, we gotta tighten, so maybe the price could stabilize. But one of the main reasons is the shale technology in the United States, and that has played a big role. So what happens, because of that technology, because of shale, the United States, for the first time, we actually become an exporter. So we have to look at the sweet spot. So we feel $45 to $50 is sweet spot for the oil. So these oil companies, and the drillers and producers in the United States, they still can operate because of the efficiency and be productive. The problem for the countries like Russia and Saudi Arabia and Iran is in big difficulty because they have to sell their oil, is, my feeling is $60 to $70. The Middle Eastern country, they need that $60 to $70. So we might be somewhere in the middle in next year. I don't foresee a $40, and I don't see that right when it hits 75, all of a sudden, all these big advisors and money managers, they all come out, and the gurus, they say, oh, it's going to be $100. Well, it doesn't work that way. So everything you will see is a supply and demand. So one of the the reason I was cautious on oil was, as I mentioned, I used a chart. So the top one is the chart of oil, the gold, and the bottom one is the oil. On the bottom, right at the bottom, is, we call it spread. So I divide the price of gold to oil. So if you can see, when the prices get closer, that means one of them have to give. Either gold is really inexpensive. So, excuse me, so I have this laser, but it works everywhere except on TV. So please forgive me again. So as you can see, the ratio in October was the lowest. Very low, and as you can see, the gold, and so this is over $75 oil, and we have a under $1,200 gold. So what do? Either we had to think that the gold is going to go up or oil is going to go down. It could not stay that way. The markets are very interesting. Markets go back, it's like a nature. They work like a clockwork. And they don't like the deviation too much from what the norm is. And you will see in the economy, everything from real estate to price of markets, they stay within their means, close to it. And you could see that the markets were kind of, again, it seemed like overstretched for oil and understretched in a sense for gold. So look what happened. Right after that, they got really trying to hug each other, then decided, oh, now it's time to leave each other. So that's why now where we are. But I think oil is going to stabilize, and we will stay and maybe go up a little bit. So this is a good time to look at some maybe oil producers. How do I use, again, the information? So I'm hoping that it will help you for your own analysis. Gold, copper, lumber, and inflation. So how do we use this? Again, this is something that is free charting. So if you like charts, I will give you the sites and you can do this on your own. I like to see things in, rather than dollar or paper money, I like to see them mostly in gold, because gold keeps its value. So I use this gold-copper ratio. I want to see how much gold is worth in copper. Now, copper, we call it Dr. Copper, because it's a good indication about the health of the world economy. And why is that? Because copper is used a lot in infrastructure. And because of that, like China was buying a lot of it. And when 2008 happened, in 2009, you could see the price of copper had actually hit $1.51. That meant there's going to be a big slowdown coming. So copper is a good indication. So when the gold and copper, when the price, the ratio goes higher, that means that copper is cheaper relative to gold. What that means there's not much growth left. So that's one of the indications that I use to show that why the world economy might slow down, and why inflation could be a little bit of concern, but we are not overinflated. The second thing I use is lumber. And why do you think it's lumber? Lumber is a necessity for building housings, right? So when the price of lumber goes down, that means, again, the economy is slowing down because they're not being more buildings. And in this case, if it's stretched too high, let's say gold lumber, that means the inflation could be of a concern. So those are the reasons I use these ratios. And then I showed you, right now we are, as you can see, there's something we've come up really fast in the gold, oil. This is oil and gold. Okay, all right. You ready for a little traveling? So here we go. I'm gonna travel around the world with you. Hopefully I can give you some information which will be beneficial. Let's just start with Asia. What is the outlook for our Asia? There are different parts of Asia. Obviously, there's a Central Asia, but I'm going to mostly concentrate in the South Asia and China and India. Well, as you know, India they're going to have election coming next year, but they also just last week they changed the central bank governor, which was not good news for Prime Minister Modi, because we don't like changes when it comes to like a Fed governors unless they retire. Modi has a challenge. He was called the Reagan of India when he came. He had all these plans for as far as the fiscal policies, and the Indian market went up, but all the markets around Asia, they are down this year, big time. So we feel, I look at India's demographically, the population is going to take over China soon. They have about over 400 million in demographically in the middle class. And middle class is very important because they're the ones who are driving consumer, because the wealthy is wealthy. They're going to buy whatever. The poor, unfortunately, they're very much, because of the classes, they stay where they are. But India has had a really growing economy. And one of the indications we see why it is growing is because we see in the weddings, as you know, the gold consumption comes about 20-25% from India, but it has slowed down. There's actually now movement to diamonds. So they're thinking Western world. So there is this power to do that. And they do have, again, young economy, and they're very educated. One of the other good things is a lot of Indians, when they come to the United States, a lot of them do go back. So the expatriates, they go back and start a lot of technology businesses. So they see the opportunities there. The problem with India is, again, with large population, is that for sort of the classes, but also infrastructure. A lot of infrastructure problems in India, so that slows down the economy. I give you one story. I remember in early 90s, late 80s, when I used to trade Indian markets, it was very difficult. They would be open only for 2 days a week for 2 hours. So you could trade it. The rest of the day was about paperwork. So the bureaucracy has been very large in these countries, but now it's everything's automated, so it's a lot easier to trade. But the bureaucracy has been one of the reasons a lot of the emerging and developing countries did not grow as fast, but now they are. Again, they have no choice because they have to stay with the, again, with the global growth. My favorite country for the next 10, 15 years will be Vietnam. They're a very small as far as capital markets goes, but it's almost 100 million population, which majority is very young. The median age is about 27 to 30, but they are very vibrant. They wake up early, they go to bed late. It's one of the only 4 communist countries in the world. There's Cuba, North Korea, the 4th one, but Vietnam is the 3rd one. But they are open. And I call Vietnam the China of Asia, because the China is reducing manufacturing. What they're doing, they're going more into trying to get into service and consumption. So what happens? The business goes to Vietnam. They are, again, very vibrant, and the markets are small. That the largest stock is, it's a milk and farm company. But I foresee a lot, again, because of the information technology. Hong Kong, Singapore, they're all down 14 to 18%, but Hong Kong is very much affected, obviously, with what's happening in the United States with our interest rates, but also what's happening in China. Other opportunities will be in Thailand. Thailand is opening. They are actually positive for this year, and they actually the unemployment is very low. So countries like Thailand, which you hear because of the tourism and other thing, but they are also vibrant, and the geopolitical size and the political risk have kind of vanished after the king died, and they had the police or the military government for a little while. Other parts, Japan, they've been living with deficits for as long as I can remember. So last 5 years, we've had the Prime Minister Abe. They are going to come up with more consumption taxes, and they're going to increase, but not as much, because they have to stop their deficits. But we feel positive, but not too much. We think Japan is going to be okay with the slowdown, but the economy is not as vibrant and as the other economies in Asia. Let me talk about China, because that's a big question mark as far as we talk about the trade war. Politically, Trump, they talk about Trump, made this thing happen, and granted, but Trump, as far as I remember, I think 15, I've read his book, he's always been of the thought of China is the evil in the sense of manufacturing. He's been very consistent in that. So now that he has the power, he's trying to exercise that. The problem with that is, in the short run, it has helped some manufacturing, but our world, with all the technology, with all the, as far as the production going from labor to actual technology, how much manufacturing jobs can you produce in the United States? What is the plus in that? So eventually they are going to disappear. The other problem with Trump's assessment is China doesn't rely on the United States consumers as much as they used to. I mean, 51% of their markets is in Europe, and the Europeans are not going to let that go. So there is that relationship. The other problem with China is they are overextended. There's a credit problems. The positive side about China is the government is in control, so they can come and they're going to ease the reserves. By easing the reserves, that means there's more money available for consumption, but also borrowing. So that's one thing about the unknown about China, what the government is going to do. They are becoming more consumption-oriented. And if you, okay, I don't have the chart, but if you look at this, like soybeans, they went up last month and a half, just because, you know, China is the biggest user of soybeans and they don't have enough, so they have to import from the United States. And with this trade war, what was happening, the price was going up. So now you hear, oh, they're talking about, okay, Trump came and after G20 in Argentina, they decided, oh, it's okay, we're gonna have this, which is, it's just words right now, but like soybeans plays, or live hogs, they play a role in China's trade. The thing with China's market is, unlike other emerging countries, Chinese, they love risk. They love to play stock market. And what has happened in the last few years, they've actually played on margins. What I mean by that, they've borrowed money on their accounts to play the market. So they had over $300 billion in margins. The Chinese market is down about 22% now, so a lot of people are not happy. So what they did, they covered their margins. They don't want to, but they can't wait to get back in the market. So because of that, so down from 300 to 100, they love to go back to 300. So that's the fuel might be coming from within China. Now again, with China, we've had a lot of problems with the information because we don't know all the companies, we don't get access to that, and that's what they came with A shares, because up to now, we only could invest in Hong Kong listed companies, which they were about 165. So I could go buy, if I wanted Chinese stock, I had to go through, but that was just a very small percentage of what the China is all about. So one of the things is we have A shares, so you actually have access to Chinese markets now. And so they do have fundamentally a big problem of credit risk, but for now, they are projected about 6.2% GDP. We feel about 6%, as much as they give us the, you know, we don't know exact number, but it's going to be close, so about 6% growth. So it's a nice number. So China could be sleeping giant for next year as far as the markets go, but in long run, I think it's not, the problems are not going to go away because of they have, again, from the debt side, they have the credit side. The good news is they're going to spend on infrastructure. They're going to build more. So that's a good news as far as their growth potential. The other thing about China, I remember when this slowdown happened in 2009, I was looking at one of the ways I gauge these things is I gauge these the health of the economy. I want to see how many Chinese are buying these new Canon cameras. That tells you, and they were sold out at no time. So I knew about 2010, things are going to turn around because they were selling a lot of Canon cameras. So when they have access, which are expensive, that means that the population feels positive about their future. I'm going to talk about Middle East separately. Let's see. Europe, there's a lot of fundamental problems, as you know. We had the pigs, which was the Portugal and Italy and Greece and Spain and Ireland. They have worked some of the problems, I mean, especially with Ireland. And we see like that Spain having the real estate is coming alive. They have some political problems. Italy is the ones that we are very concerned from the political reasons. Because of we will see a theme with the populist policies around the world. So you see that in Italy, and we see that in Germany with their elections, and we see with UK with Brexit. So there's this, that the average person wants to be in control, and the politicians are playing to their games. So in this case, I think with Italy, there's going to be a problem. Germany, they have elections. France has lots of problems with Macron. As you know, last week there was that uprising about they call it the gas prices. But more than that, their economy has slowed down for a few reasons, but one of them is they had a very hot summer. So because of the drought that affected them, and they had a really bad winter. So this large snowfall affected there. So we feel next year might be improvement for Europe. They are not gonna, as far as tightening, they're gonna keep euro, because of the exporting, they're gonna keep it where it is, or it might be a little more of a appreciation. So if you wanna go to Europe, still a good time, please go. Let me talk about, as far as Eastern Europe, before I go to Eastern Europe and Central, which are their emerging countries, let's talk a little about Brexit. Now, Brexit, as you know, there was supposed to be a vote this past Tuesday, but the Prime Minister May didn't have it. And the reason she didn't have it, because she had negotiated. Brexit is when, British people decided to get out of European Union and they want to have the independence, which has created tons of headaches for the companies and businesses. But it was what the people, we're talking about populists, that's what people wanted. Obviously, the institutional side says they didn't think about it, but this is what it is. So May decided, which is their prime minister, said, okay, last Tuesday we're going to have a vote. We have come to negotiations with the euro, and the European unions decided to accept what they had. And that's where there was uprising, because anytime Europe, which is a bunch of bureaucrats, accept something, that's when you run away. And that's what happened in UK. People want to run away because they said, if they're so agreeable, we don't want the part of this. So March 29th is a big date, but before January, end of January, they have to have another vote. So our outlook for British pound, if anyone is interested, pound has been floating between 127 to 130. And we've had this. We broke that down after the news came with 127. The low we had been is 120, 121, and the high has been 142. We might hit that 120 before you know it, but right now we like to go back over 127 for stability. And that's, again, if you want to go to UK or Europe, these are great times. Dollar is strong. This is a good time. I would be hesitant to buy British pound at this time. I will see what's happening in the next month or so, but that is something that we should watch, because obviously London plays a huge role, but also is an indication of what's going to happen in the rest of the world, and we will see that in Latin America, the same thing. So again, it's a populist policies. Let me talk about Eastern Europe. That's where we see there will be growth. I think about 3.1 to 3.3%. Eastern Europeans, they're the ones who were under communism for so long that when Poland was the first one, when they came out with the uprising, they ended up, unfortunately, because of the social agendas, people had become kind of content with what they had. So there was this revolution of mindset. They have gone over that. I mean, when you talk about Eastern, they are very hardworking. A lot of Polish people go and work in the UK, and they send the money back to Poland. So they do have a very good discipline, and they are becoming, again, the countries that we see in Asia or Latin America, they are growing in a sense. Obviously, we have Ukraine dilemma and with Russia, and that's something that is, the Ukraine debt was a big question mark, a lot of problems with that, but even Ukraine could be attractive in the future once these policies are settled. Croatia, you go to Slovenia, Czech Republic. Czech Republic is, the growth will be better than average in Europe. So once we travel to these countries, I think you will see more productivity from those countries. And the two other ones I would like to talk about is the Russia, and Russia, perhaps from fundamental valuation, is the least expensive. I have been in and out of Russia. There's the telephone companies, the cellular phones. Unfortunately, again, because of politics and transparency, you don't know. I mean, you can be a be a billionaire, and next thing you know, they say, well, we want your money, you will be in jail. So these are the problems with these countries in, let's say, Russia. But there are, again, attractive valuation in Russia. Obviously, the risk premium is high. So, and Turkey is its own. Has its own agenda, but they've had a lot of fundamental problems. Their currency has been devalued a lot. Obviously, you know about the uprising the coup d'état, as they tried with President Gül. What has happened is we feel they're not out of danger, even though I bought them 2 months ago when there was a huge problems with President Trump, and so the valuation was very attractive. So we are out of Turkey right now, but that's something to look. Majority of investors in Turkey, they are not local, only maybe 5%. Majority of 70% is European or pension funds. So these pension funds are the ones who run the stock market. I remember I was in Istanbul Bursa in 1988. It was a very small old building, and it was $30-40 million a day transactions. Today, you go, it's a beautiful building. Last I was there was like 2009. Beautiful building. It's over $1 billion in market cap. So there's a lot of money coming from Europe. So I would not discount Turkey because they are a player. They do have expats in Germany, for instance, and they do communicate. They do bring a lot of money back to tourism. So Turkey is interesting. Let me talk a little about Middle East, Qatar and United Arab Emirates. We've heard a lot about that. It's Qatar is a growing economy as well. They are trying to get away from oil. A lot of these Middle Eastern countries are trying to be diversified. We just talked about. So they're trying to natural gas and also the financial side of things. There's a financial capital, really, when you talk about United Arab Emirates, which didn't, 40 years ago or 30 years ago, who would have thought, Dubai become the financial center of the world? Some of the people say the reason was because of the revolution in Iran in 1979. Iran was a thriving economy. Because of that, a lot of sanctions. So the money basically went to Turkey and went to Dubai. And there was about 50% of the population of Dubai used to be Iranian. So a lot of businesses went there, and they were freely able to invest. And because of sanctions, a lot of products could not come to Iran. So what Iranians had to do, they had to lease it from Dubai. So if you want to have Sony, or you want to get Sharp or Canon, you had to pay 50 basically. All right. Sorry, I'm not answering your question, but please write down your question. So, so let's go to America. Argentina had a big problem, but there's nothing new about Argentina. Argentina, for past 100 years, if you don't have a new government within a year or two, there's something wrong. So they were one of the richest countries in the world in early 20th century. Beautiful country. It's absolutely beautiful history, very rich, but the people, unfortunately, they haven't adjusted to the democracy in a way that they should. So the capital markets are still small. The fixed income is 3 times their equity markets, but they do have some attractive valuation. The problem is you don't know as far as politically what's going to happen. There's the corruption. There's obviously, again, the cultural hindrance on the free capital markets. But one of the companies I like in Argentina is their McDonald's, which is called Arco Donados, but its symbol is IARCO. So food is always good whenever you go around the world. So if they do have in next segment, when we'll go, I'll show you how to find these companies on your own. So you don't have to ask anyone. Brazil just had an election on October 28th, the far right. We don't know. That's something. Brazil has large natural resources, but we talked about political risk. When we had Petrobras, or PBR, the government just came and just took over. So it's like, okay, just because we can. So all of a sudden, a lot of Petrobras investors were from the United States. The stock was big. And obviously, because of irregularities and because of the corruptions, as you know, the president and then the last president, Lula, the one before 2 presidents ago, they all, because of corruption, they went to jail. And that's something that happens often, unfortunately, in Latin America. There's a couple of countries. I like Colombia. I like Chile. Just the problem with Chile, and especially Peru, is they are very much natural resource mining dependent, so that kind of makes us hesitant. Colombia has come a long way, and of course Venezuela is depressing to talk about. Here's one of the richest countries in the world. Has some of the, I remember growing up, I mean, every other year the Miss Universe was from Venezuela. I mean, they were so educated, and it all takes talking about politics and mismanagement, and look what has happened. As a matter of fact, talking about returns, I mean, a few years ago, Venezuela was the #1 stock return in the world. It was up 337%. Today, inflation, their currency, we don't have enough zeros to put in. So people are flooding Venezuela. They're going mainly to Colombia and Peru. And it's very sad because I've met so many nice Venezuelan people, and it hurts me. But unfortunately, the markets are not that attractive, obviously. Other than that, Uruguay or Paraguay or Bolivia, they are not really liquid markets. We moved to Mexico. Mexico also had an election. We don't know. It was a left of center. But Mexico has obviously natural resources, and that's something which the oil affects them. But their biggest partner is obviously the United States. And with the new NAFTA treaty, which is changed to UMCA, which is USMCA, US, Mexico, Canada, we feel that should help with their economy. But their currency is still weak, so that's something that should improve. Canada, they have, again, because of the natural resources, the currency is still weak, and we won't buy it at this time. They are very much, again, involved with, there's oil, gold mining. But one of the things I like about Canada, and that will be the future, I think uranium might be a subject for next year. I think the uranium companies, because of the nuclear treaty, is actually falling apart in many ways. But also, in 1990s, we had 500 uranium companies. Today, we have 22. And most of those companies come from Canada. So that's what we see. US, I will talk a little bit later, but we see as far as the markets go. This is where I want to spend a little more time. Africa. I am disappointed, but I'm so excited about the future of this rich continent. Africa has one of the richest natural resources, but I'm more excited about they have very fertile grounds. The food production will be the most important thing, I think, in the upcoming next 30 years. And when you look at the sub-Saharan and then we go to the northern, there are a lot of fertile grounds besides natural resources. I mean, we hear, obviously, there's more oil is being found, diamonds, platinum, gold, and of course, then we talk about soft commodities like cocoa, for instance, which comes from Ivory Coast and Ghana. The problem with Africa is because of the centuries of what has happened, the corruption still is rampant in there. Once that's, hopefully with the technology, with efficiency, they will get out of that mindset. And obviously the access to, for instance, electricity, drinking water. So it's more of a World Health Organization kind of a deal than economic kind of a deal. So once they're taken care of, because of the average life expectancy is very low. And I give you an example, like Nigeria is the largest or most populated country in Africa. And you go to Lagos and the traffic is worse than it was 10 years ago. But most people know Nigeria because of those spam emails they receive, that we have $10 million waiting for you, and basically that's the problem with these countries. Nigeria doesn't have the electricity, only 47% have electricity. Ghana has improved a lot. Nigeria has lots of oil, and unfortunately these countries, they have so much potential, and there's just so much hope with young population that I feel Africa will be the future. Ghana is very attractive to us. They are moving in the right direction, except they have very small markets. Morocco is very expensive, and this goes back again to regulatory and political. So what happens in Morocco, 36% of the investors come from pension funds, another 32 to 34% are institutions, 20% are another big, large, and this is 90% of the markets. They cannot invest more than 10% outside their country. So all the money has to stay. So when the money stays it gets expensive, and they don't allow foreign investments freely. So countries like that, which they could be invested, it's very difficult to invest. So basically the future for Africa will be, again, lowering the corruptions. We want electricity, drinking water. One of the companies that we invest in is the ShopRite, which is a supermarket in Nigeria, which is listed in the United States. So Egypt has always been interesting, and obviously you can invest in Egypt through ETFs, so exchange traded funds. So, and the South Africa has had their own problems. The currency has been devalued so much. They have 25% unemployment, and it's again such a thriving country, and because of mismanagements. Then Zimbabwe could be attractive, Tanzania. So there's a lot of up and coming, and next segment, I will show you some of the suggestions I will have. I think we're almost going to have I'm going to, again, this is part of, so there's a Shiller, he came and looked at the valuation of the countries around the world. So I've listed some of the most attractive countries based on valuation. So Russia, Hungary, Turkey, China. But again, this doesn't take into effect the geopolitical part of things and the politics of things regularly. So this is just an absolute valuation. So you will have this. We're almost done for this segment. So you will have a copy of this. So just briefly, how can we, okay, we are excited, we want to buy these things, how do we do that? So there's few ways of doing that. One of them is American Depository Receipts, there's ADRs. These are the large companies around the world that they are actually listed in New York Stock Exchange. So what they do, they buy maybe 5 shares and represent 1 share, and it's Bank of New York, Mellon Bank of New York is the one who puts all these together. So you think about Alibaba. Alibaba is a Chinese company. It's like a Nokia. So basically, or Turkcell, Miptel, these are all the companies that they have a listing overseas, but because they're listed in New York, now we have access to their accounting. So now they have liquidity. So we can buy and sell them easily. So I will show you how you have access to them in the next segment. But they are one of the most attractive, which used to be very expensive to do that 20, 30 years ago here. But click a button, you can buy any company that you want, as long as they're listed. Exchange-traded funds have grown tremendously. They are almost like stocks, mutual funds which act like stocks. And nowadays, there's just so much accessibility. You can buy in any theme. You just name it. I want female CEOs company, or companies run by female CEOs. You got it. I want to buy soybean. I want to buy platinum. So these are all accessible, which is wonderful for consumers. Mutual funds, obviously, it has been one of the easiest way for decades that people used to invest their money. Even 401ks, most of the 401ks are invested in mutual funds, which is a pool of stocks or equities or bonds all pulled together, and it gives you the liquidity, and also it allows you freely to invest where you want. Closed-end funds, before exchange-traded funds, they were the way to go. They are not as popular. It's a little difficult to understand them, but they're still attractive. Then multinational companies. I mean, just think about IBM, McDonald's, Apple. There's a lot of their revenue doesn't come just from the United States. They have presence all over the world. So like Deere and Company, and a lot of those. So that's another way of having, as far as exposure to different countries. The last two is the U.S. traded foreign stocks. I was asked when Samsung had that debacle on the airplane, you know, that it got caught fire and everybody hated Samsung. Somebody asked me, oh, I wish I could buy it. Well, you can buy Samsung in the US, except it's listed on NASDAQ. And what happens, it doesn't have as much liquidity, but you still can buy it. So anytime you see it, usually it's like a 5-letter symbol. It ends either with F, or if it has a Y at the end, then you know these are foreign companies listed on NASDAQ. So they're not, again, liquid, but you still can buy it. Gazprom, for instance. Gazprom has a really interesting story to tell, but it's not listed. It doesn't have ADR, so it is listed on NASDAQ. The last one is trading on foreign markets, and that's what I used to do years ago, and it was very expensive because we didn't have access to all of these. So what we had to do, just go to the market, go to the bank, and spend hours, and very expensive. Nowadays, there's like interactive brokers. There's a few different brokers. They actually allow you to invest with any currencies that you want in any market that you want. So we are living in very exciting times, and thanks to, again, technology. Okay, I can start this in the next segment because soccer is a big passion of mine. So I just want to help you with some of the investments ideas about why I think soccer is interesting. Okay, we'll do it. I've listed, these are some of the helpful sites that I use. They're all free. The next segment we'll go over just the first 2 or 3. But the Forex Factory, I'll show you. It gives you the calendar of events around the world. So, all right, if there is going to be interest rate increase somewhere in Australia, when are they meeting? Tomorrow. Oh, okay, so I'll be prepared. So I make sure I don't get into Aussie dollar, just wait. Finviz is one of my favorite. It brings everything under one roof. So that's when I'm going to go, if you don't mind, time-wise. In 2 minutes we'll have a break, but that's what I will show you how that. And stock charts is, again, it's very it's free, but you can get charts of everything, almost everything in there. Economist, IMF, which is the International Monetary Fund. ADR, BNY Mellon, that's where the ADRs are. Bloomberg. And if you want the ETFs, you can go to etftrends.com and etf.com. Again, you will have copies of these, but if you want to. Just a couple of more charts I want to show you. This is the chart of the Home Builders ETF. As you can see, you look at right around January, that was the highest point. And since then, all we've done, we've come down. So that was a warning sign to our real estate and also our markets that home builders are not making as much profit. So like your Toll Brothers and there's quite a few that they consist in this index. So these are the things that you can use on your own to find out what is happening to our economy in the United States. Another chart, again, you can jot these down, and that I look at, talking about the United States, the S&P, I want to see how many of the stocks are under their 200-day average. So when they are really high, that means we are overextended. When they are really low, that means maybe we are oversold. We have to think about maybe getting the market. Now, but we want to make sure there's a change. So you can see that big red line. That means how many stocks actually just gone down since this is on a weekly basis. So we don't see yet the turnaround. So I will be cautious. So this is again, the reason I put these here, you can go on this site and see what is happening with the health of economy and the stock market. On the other hand, this is the utilities. When you think of utility, do you think aggressive investments or conservative investment or defensive? Utilities are usually defensive. So when you think of technology, boy, can't wait to get in, volatile, high beta. But when you think of utilities, healthcare, we are defensive. Look at what has, from the beginning of the year till now, it has a nice chart. So it gives us 2 indications. Number one, that the markets are being defensive, so they're putting the money in the utilities. The second thing is, as you can see, last few weeks, it has actually gone up even more. That tells us that the fear of interest rate increases is diminishing. Why is that? Because a lot of utility companies live on borrowed money, so they have to pay this interest. So because of that, we feel that maybe we are not going to have the 2 or 3 hikes. And if the hikes happen, they will be in the beginning, and then I think Fed is going to just take its foot off the gas pedal. So again, the reason I put these, so you can compare it like 2 months down the road and see. I also put some currency ETFs, If you want the dollar, you just want to put it in your portfolio, it's UUP. What if you are bullish on Europe? What is on franc? But what if you are not, you're actually bearish on Europe, that's EUO, that means you short it. There's Japanese yen, there's Chinese and Canadian dollar, there's Chinese renminbi. And the last part is I just put some ideas for you, some of the exchange traded fund, closed-end funds that you can actually explore, from Africa to like the utilities. FUTY is global utilities around the world. I put PIO and CGW. They are the water utilities, because I think water is a very important commodity in the future. Without clean water, which is very low, life is not going to be sustainable. So these are the companies. Some of them do the waste. Actually, more people die because of the not having the good waste facilities than even drinking water. And PHO is the water utilities in the United States. For real estate, again, we have RWR, RWX. There's a global, international real estate if you want to invest. They're liquid. VNQ is a Vanguard real estate. And IGF is the infrastructure. So we feel the infrastructure spending will be higher next year and more of a stimulus. And then country fund, I put down Vietnam, Qatar, Thailand, Russia, Nigeria, Egypt, Poland, and South Africa as an examples. And the emerging markets, frontier markets, there's Africa, there's Middle East, which is Gulf. So if you want to invest in any of these themes, these are just some examples. I think that's it.